Welcome back to the Business Blox podcast. I'm Chris Manser.
And I'm Dale. We're back again out of Chris.
Yeah, another week, episode 14. And this week we'll be looking at understanding your profit and loss and maybe touch on the balance sheet if we have time as well.
Okay. So I don't think there's anything pressing that's happening in the market today for the first time in a few weeks. There are talks again of things starting to roll back, but nothing in relation to funding, nothing in relation to, that sort of thing. So let's start talking about the bare basics of accounting and what are the building blocks of how things work. So I thought we'd start with the profit and loss. Do we have the screen? Do we have my screen?
So we're sharing the demo company.
All right. So basics to a profit and loss are you've got income, which is obviously the money that you earn. Cost of sales. Now, cost of sales is anything that directly relates to selling a product. So if I was selling, let's say I was an electrician and I installed, electrical equipment and all that sort of stuff, I'd want to have my materials up in here and also my labor up in here. Anything that directly fluctuates up and down to do with a sale. And what that means is that people are able to get a good understanding of what money they've got left to pay all their fixed costs. So everything here is something that just keeps ticking in every week. So it could be telephone bill, electricity, fixed office people's wages. So the people who are just office workers, rent, all those sort of things, they come down the bottom here. And what you generally do is you can pull up multi-period reports and you can see that, all right, you want your gross profit as a percentage sort of to stay in line with your sales, because you have your purchases which go up and down with your sales, your direct wages that go up and down with your sales. So that margin, which is the amount that you try and charge the customer, should always sort of remain at a consistent level. And that way you can use that part of the profit and loss just to make sure that what you're quoting is what you're getting back. Does that make sense?
Yeah, it does. So you're saying that so sales less the purchases gives you the gross profit, which gross profit is if you bought a physical item and sold it for a price, that is the profit you made there before any other operating expenses. Yeah.
So when I quote for something, so let's say I'm a builder and I go out and I quote a job and I want to make, double my money, you should be able to see the gross profit figure should be the same percentage as your sales. So if I want to double my money, my gross profit should be half my sales, basically. So that's sort of how you use that top part of a profit and loss. Let's say I sell a product and I sell, let's say I sell TVs. If I want to double, so if I buy something for $100 and I want to sell it for $200, my gross profit should remain half of my sales. And what you can use that to do, you can use that to track to see if there's any problems inside the quoting area of your business, and then you drill down deeper into that area of the business and say, okay, well, if I'm not recovering on my job, so if I'm quoting 100% markup and I'm not getting that kind of money, there's got to be something wrong in there. That's when you sort of start to analyze down into that sort of area. I think that sort of gives you the basics behind it. Other income, neither here nor there at this point in time. Then what you want to do is you want to have a good allocation of expenses that gives you, very clearly big and identifiable headings. So you've got advertising as one, bank fees, all things that are generally easily split out. Now, if I had the scenario of that I had advertising and my advertising expense was, say, $100,000 a year. Okay, so let's say that I had advertising and my advertising was $100,000 a year. I might find that I need to break that advertising expense down into a couple of columns to sort of get a better understanding of what's going on in there. I might find that I have a number of motor vehicles and I want to break that down into each motor vehicle to see what I'm spending there. You sort of do that to an extent where you can use this to make sure that the expenses aren't going up, or there aren't anything out of the ordinary that you can sort of that comes along the way. So you get down. Yeah, go.
Yeah, So going back to the chart of accounts. Creating the expense lines. At what sort of level? So right now, that's a pretty good breakdown. There's roughly 20 expense lines.
Yep.
How much do you go further than that? At sort of what value do you really look to expand, or do you even delete some of those extra rows that you won't be using?
The less you can do, sort of the smaller the figure you're talking about, the easier it is to do less numbers. I don't like the general expenses or the consulting, the things that are general in nature, where as your business gets bigger and you sort of have a less of an understanding, it's hard to see what goes into those areas. If you're starting out a new business, less is definitely more. You'll have your hotspots, you'll have your car, your phone, basically everything you see on the screen there. It's sort of where you keep it at. As you get more advanced, you can then start to play around with how the profit and loss looks. This is sort of the basics of where you'd start to look at it. So you'd have your sales, you'd have the cost of those sales, a gross profit or what the gross margin should be, and then all your fixed costs, and a sort of a good way of breaking it down into grouping areas. So, let's say that you had, what would be a good one? So I'd say one thing that used to be broken down but isn't anymore is motor vehicle expenses. So people used to break it down into fuel, rego, insurance, but I don't think that there's a need for that anymore. And generally the need varies from business to business. So if I'm spending up big on advertising, maybe that's an area that I should put a bit more attention into and make sure that I'm hitting what I think it is. Then you come down to net profit at the end of the day, and that's always, that's the money the business is making. So you generally find that the figure, as a sort of easier way, the figure that comes down to your net profits should be moving into your bank account. So if I've got a loss of $11,000, I should see my bank account go down by $11,000 or something along those sort of lines in a basic scenario. Multi-periods should always be looked at. So what people do is they sort of look to see what trends are happening in each month. So you'll find that, when are my good months? And you want to start matching your good sales months to your good expenses months. So you don't have any huge dips in the net profit, because that would then put a drain on your bank. You can, I don't really see it often, but you can sort of look to keep this at a small figure with an ever increasing bank account, and then towards the end of the year, because it's tax time, is probably because it's topical, you then look to put that into some sort of expense there and sort of pay things out. Other things people look at is they run different sections of the business. So let's say there's an office, and then you've also got a number of people that are on the road. You can start to break down your profit and losses into regions. So money directly earned from inside the office, as opposed to expenses for direct to the office, or money earned from sales team 1 as opposed to and expenses directly to sales team 1. So that's sort of a way that you take bigger numbers and you break them down. So you start to run multiple profit and losses. That's sort of the basics behind profit and losses. It's good to keep everything allocated correctly. I think that the place where people fall over the most is not allocating to the cost of sales well. So that's probably the biggest pitfall, and having a really good understanding of the gross profit. I think most people would run most of their wages down here and not up here, but there are ways that you can go and split where they get allocated. That's probably something I'd suggest. Other than that, allocating it properly to the right accounts is the only way that you can get a good indication of how things are going year to year. So if you start on something, in 5 years ago, and you can maintain those same descriptions and the same headings, it gives you a good history to sort of review what's going on and what's increasing, what's decreasing, that sort of deal. That's probably about, I think that gives us a good grounding of the profit and loss. Is there anything else you might?
A common question we get after the profit and loss is, we're looking at the profit and loss. The business shows a profit, and then the business owner says, I've got no money in my bank account. So can you sort of explain?
That's with the balance sheet. Yeah.
Okay.
So in a small basic business, it's money in, money out. So you get money in, you get money out. It gets weird and wonderful once we start talking accruals. Now, accruals is an accounting term that means we start to use money. So we start to take up expenses incurred and income earned but not received. And what that effectively does is it records income before you've received it and expenses before you've paid it. So you might have $100,000 profit in sales, but 50,000 of that might be an invoice that you've raised you haven't received yet. That's usually the way that gets varied. It does also vary when you start pulling cash from loan accounts and things moving through the profit and loss. So let's look at a basic profit and loss. Don't get more basic than that. All right. So your bank, which is your money, which is sitting in your bank account, and your accounts receivable. The accounts receivable, now that's what we were talking about before, which is the money that's owed to the company. So what you have is you should be looking at now this is when it sort of gets a little bit more tricky, but it's sort of a good thing to understand. There's a thing called current assets, which is anything that's receivable with under a 12-month period. And that way you can sort of look at these two together and see that effectively your accounts receivable is cash. So it's cash that we just haven't received yet. Now, sometimes there's components in there that aren't going to be received, but you should remove them out as soon as you know they're not. So what I can say is, all right, currently I've got 15,000 in the bank and 10,000 I'm about to receive in the near future, be it 3 months, 2 months, 2 weeks, whatever it's going to be. So if I looked at my net current asset position, which this doesn't have, I would be able to say that, all right, from a figurative cash position, I'm still okay. So although I don't have it in my bank account, I've got, $10,000 sitting here. Fixed assets are assets that are bought. So these go over a long period of time. So they sort of have a weird effect on the bank account. So I can spend $10,000 out of the company bank account and put it to the fixed assets. So I buy, let's say, a car. That's not going to show up in my profit and loss. So in my profit and loss, I'm still going to be making $10,000, but I've bought an asset worth $10,000. So my bank account's not going to reflect that. And that's when it starts to get hard to do that basic understanding of, profit should equal cash in the bank. If you're not buying any assets, if you're not running up any major liabilities, you should be able to say, all right, cash at bank, accounts receivable, roughly that's the money I should receive in the near future. Grab that. Then you got total assets, liabilities, which is sort of the reverse of what we were talking about before. Accounts payable, that's the people I owe money to. So anyone who I raise an invoice for and I say that I've got to pay them money, that comes into the accounts payable. Bank account would be a credit card. GST is your GST liability, and that's your PA wage liability, and that's just a sundry asset. So what we then come down to now is the net asset position. Now that's probably, I'd say that's an important number that people need to look at. So what that shows me is that this company owes $5,500 more than they actually have coming through the door. So they need to grab $5,500 of future profits to pay off old debts. So they're starting to slip into a backwards position. So people really need to keep an eye on this net asset position. And once that starts to turn negative, they need to start talking to their accountants. And if that keeps, systematically going backwards, then the business is losing money. Not always the case. There are instances where accountants do weird and wonderful things, and then that's not the reason why it's happening. But as a general rule, if your net asset, and if anyone else takes anything away from this, if your net asset position is negative, talk to your accountant, because there may be something that needs to be done. You may need to plan your way out of a bad situation. And then equity, this is where your income goes when it gets transferred from the profit and loss, basically. So that's probably neither here nor there for anyone. Net asset position, that's what I give the takeaway being.
Okay, and with regards to smaller businesses, sole traders, the balance sheet is a lower priority, or would you still focus on the balance sheet?
It's harder to read, yeah. Mm-hmm. It's a balance sheet is a lot more neglected than the profit and loss. I think the profit and loss is a good indication of how you're going day to day. The balance sheet is probably a better indication of how you're going long term. Yeah. So that's sort of saying long term, all your wins and losses get recorded on your balance sheet. Every year, the profit and loss gets cleared out and we go back to zero. So we get a fresh sheet. That all gets pushed into your balance sheet and it doesn't disappear from here. So if I've got a loan and it's getting bigger and bigger and bigger because my profit and loss is losing money, after the year rolls over, my profit and loss goes back to zero, but that liability still sits there. So it is just as important. It's just a little bit harder to understand, and it takes a bit more of just an understanding of how accounting works, I think. So, yeah, that's why people understand profit and loss. It's what I make. Net asset position is just as important as your net profit position, because it's an indication of where you're at the longer term.
Okay, and what we have found is going back to the questions of if your profit and loss is positive and you are making a profit and you don't feel this is correct, one of the common mistakes we see is people pushing reconciling expenses onto the balance sheet. Yeah. So not taking them up. Like, for example, office equipment is a very common allocation line. Instead of allocating it to the expense in the profit and loss, it ends up on the balance sheet, and it increases your profit when you've actually purchased equipment that should be expensed.
Yeah, and that's why you should try and read the two in conjunction with each other. So, profit's good, but I got no money in the bank. Maybe I bought an asset. There's all that. That's, I'd say that'd be step 2 for people. Step 1 is understand your profit and loss. Step 2 is balance sheet.
Yeah. Okay. Anything else you want to leave us with?
I think that's the basics behind it. I balance sheets are a very neglected thing. Moving things between, I know this is probably getting more technical, but current assets and non-current assets and non-current liabilities. So things that I owe in the short term as opposed to things I own in the long term. If you allocate them properly, you can then start to pull reports out that then show you like there's a ratio called the net current position, which compares your current cash position to your current liability position. So you can start to see where I'm at on a short term level, but where am I also at on a long term level. That's sort of the basics behind it, but spend time on it. If you've run a profit and loss or a balance sheet for a long time and you haven't really changed it much, and you don't really think it gets cleaned out, which is sometimes a problem, so you need to clean out your accounts payable. End of the year, it's probably a good thing to do. Clear out any old unpayable accounts payable, and also any accounts receivable that you know you're not going to receive. Remove them before the end of the year. Then you have something that you can use to start to run your business off. If you don't do that and you've got old information everywhere, the figures become less and less meaningful, and you can start to say, well, I got this $10,000 invoice that's been on there for a year and a half. So you think you got $10,000 extra coming in, really, where that should have been written off a year ago. Now things don't look as good as they used to. Now I can't cover all my current liabilities. So learn current liabilities as opposed to non-current liabilities, and sort of start to grow your knowledge that way.
Okay. And also, week before the end of the financial year, anything we need to do?
A few things we mentioned, as we said, clean up your. You may. I don't know if I can. No, I was going to say you may want to review your wages before the end of the year to make sure that everything is being paid accordingly before the end of the year. Any bonuses that you want to declare. I know that the situation surrounding payments is favourable this year. It's something that we have people looking at. So, review your profit situation just before the end of the year. Reconcile everything up until basically today's date, which is the 23rd. And then I would say roll on into the next year. If you've got time, do planning based on the year. Sit down in about a month's time, review the year, review the profit and loss, review the current position, and sort of say, how did we go? Did we go where we wanted to be? And then set goals for the next year. I think that's probably the best thing to do.
Sounds good. And if you don't want to do any of that and you want Dale to do it for you, they can send you an email
Chris.
at give you a call, or dale@taxforyou.com.au can help out with that. That's what pretty much the last 2 weeks we've been doing is chasing clients, organising. It's not necessarily tax planning, it's more that how the end of the year is going to look, tax minimisation as legally as we can do it. I think it's been the focus.
Yeah, or sign up to our email list, and then we may start to push more information to people about how they can sort of learn about profit and loss and balance sheet, because it's not something you're going to learn in a second. It's something that you're going to learn over time. Just spend time looking at it, and over time it does make a lot more sense. It's like anything. All right, thanks, mate.
See you next week.
See ya. Cheers, mate. Bye.